Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hi everybody, my name is Min and I'm your host for today. And I'm from NDIS Property Australia. And you're listening to the SDA Housing Podcast, a show that explains, highlights, guides and brings awareness about all things SDA in this ever-changing NDIS world. Today's exciting guest speaker is Joz from Barwon Investments in Sydney, a fund manager who is very active in the SDA space. Joz, welcome, and please introduce to our listeners who you are and what you guys do.
Yeah, sure. Well, I'm Joss Ingebretson, and I'm the portfolio manager for Barwon Investment Partners Specialist Disability Accommodation Fund. And what we do is we invest in best-in-class SDA properties right across Australia. Bit of background about myself. I'm based in Sydney, started out in the professional world as a civil engineer, but then moved into the property development space about 10 years ago and working across a range of different accommodation sectors in Australia. And in terms of Barwon, I joined the business just about a year ago now when we launched our first fund in SDA. And what Barwon is we're an independent and boutique fund manager. We were founded around 2006, 2007, so we've been going around 15, 16 years now. We've got 43 people. We're headquartered in Sydney, but we've got small satellite office staff in both Brisbane and Melbourne. And what we do is we manage $2.9 billion of capital on behalf of our institutional and high net worth clients, predominantly across three strategies. So we have a global investment strategy, a non-bank finance lending business, which actually we lend to developers, as well as a direct ownership of real estate, predominantly in the healthcare sector. And then in SDA, that's our newest strategy. So that's been running for around about 12 months now. And that's me, managed by myself and my investment manager, Zach. And we've been slowly building a portfolio in the SDA sector.
So with all that work you guys have been doing in the SDA space, how has the company Barwon Investments progressed and what are the achievements the company has done in the last 12 months or more?
Yeah, absolutely. Well, I guess our journey in the SDA space starts a little bit longer than just the last 12 months. Given that Barwon has built a top one, top two, top three healthcare real estate business over the last 10 years, we've built really deep relationships across the Australian market, particularly in healthcare real estate. And we had a lot of our healthcare partners actually kind of suggesting to us about 3 years ago now that they have a lot of people with disability that were stuck in the hospital system. And perhaps, given Barwon is such a trusted and credible partner in the healthcare real estate sector, is there anything we could do to assist in the SDA space? So we were kind of flagged to this around about 3 years ago now. And so for 2 years there, Barwon just spent its time really understanding the space, really understanding the intent of the NDIS and the outcomes that the NDIA were hoping to achieve for people with disability in the accommodation space, looking at how the market was forming and developing, who the really good partners were, before actually starting to raise capital, which we did 12 months ago now in August last year. Since that time, we've actually acquired 4 communities consisting of 37 dwellings, which actually support 55 participants across Australia. So we've got 2 of these communities up and running now. So they're fully tenanted. One's in Sydney in Ryde, and one's in Brisbane in Arana Hills. And then we've got 2 that are under construction at the moment with our trusted development partners. So we've got one in Perth and another coming out of the ground in Melbourne at the moment. Yeah.
When you say communities, what does that mean?
Yeah. So I guess what it means is a cluster of dwellings for us. So for an example, our High Wycombe property, which is in Perth, that was an opportunity to partner with the local CIL and SDA to actually transition 24 participants out of basic and legacy stock. There was a large, there was 24 participants across, I think it was 3 or 4 properties. So they were larger group home style of accommodation. And that particular community of residents, they all wanted to actually live together. So we looked at working with the developer to identify 8 plots of land and build 8 3-bedroom houses that all backed onto each other with a community garden enclave, so that community could stay together. So when we think about transactions, we kind of prefer to think about how do we acquire a community of properties where NDIS participants might be able to live.
So these 8 houses in High Wycombe, are they HPS or IL or robust? Are they OOA plus 2, or is there like 3 participants per house with a separate OOA dwelling, separate to all that? What's the breakup there?
Yeah, so it's a OOA within each of the residents. So they're 3-bedroom 3 resident houses, and they're actually a mixture of IL and FA predominantly.
That's great. And your Sydney ride?
That's right.
What's that breakup? What's the summary of that deal there?
Yeah, so we are always trying to make sure that our properties have a high degree of amenity. The Ride property is right next to the Top Ride, or pretty close to the Top Ride shopping centre, and that consists of 10 apartments plus a separate OOA unit in an apartment building, consisting of 8 1-bedroom apartments and 2 2-bedroom apartments. Now, those are all designed to HPS, but they catered for a mix of HPS and fully accessible tenants at the moment.
Just so our listeners can know, it's not easy doing these kind of projects. So don't think just getting a bunch of apartments or a bunch of plots of land and building it is very straightforward. When I met you, Joz, you said to me, you guys search for A grade blue chip, top 2%, top 5% kind of product. Explain to our listeners what that means and how you go about that.
Yeah, absolutely. I mean, the first and foremost for us here is making sure that we take care of our participants. And that the outcome of that is that we'll hopefully have participants staying in our accommodation for a very long time. So when we think about blue chip, it's like any other real estate asset class. It's all about location, location, location. But of course, we need to factor into, the dwelling of the design of the dwellings to make sure that they cater to the participants' needs. So blue chip for us means really high quality locations. So we're talking within, kind of 5 minutes walk or roll of a major shopping centre precinct, access to both heavy, light rail and buses, if possible, if those locations permit it. Close proximity to major hospitals, making sure that there's, parking and accessibility for participants and their carers. All of the kind of typical things that you would want out of really high quality location to live, kind of acknowledging that mobility factors are a key consideration with participants. And then in terms of the design of the dwelling, we want to make sure that the homes have sufficient storage, sufficient size, and sufficient automation to make sure that those residents can live as independently and kind of autonomously as possible, and really given a great quality of accommodation.
Gotcha. Now, how many tranches have you raised so far, and where are you at with that? Yeah, so
as I mentioned, we raised our first tranche in August last year. That was around $32 million. We've all but deployed that capital at the moment, and we've just actually finished raising our second tranche at the moment. So that's all tidied away with another about the same money again. And we're actively reviewing over a pipeline of around 100 million in options, in opportunities at the moment, I should say. We are predominantly focused on SDA. However, we are, starting to think about how we might be able to service other needs under the NDIS. So that's whether that's STA accommodation, whether that's respite or retreat style accommodation, transitional MTA to perhaps help some of that transitional need out of hospital. But also we acknowledge there's a large quantum of the disability sector that won't qualify for SDA. And so how can we as a real estate and capital partner to the sector help provide great housing for those participants as well?
I think it's great that you guys are venturing into the STA respite accommodation sector. I mean, I don't think there are many other fund managers, institutions who are looking at that. Are you aware of many other guys venturing into this space as well, like you guys are thinking?
No, to be honest. I think STA is a really interesting and exciting opportunity. We love the opportunity to be part of the SDA sector and bringing people's and developing people's and owning people's forever homes. But there's a huge need for respite style accommodation, both on the kind of respite for potentially the family and carers, but also the retreat style accommodation for participants. Not really familiar with too many examples of it at the moment, or many other fund managers really trying to dig into this space. But it's whilst we haven't gone forward with any project on it yet, it's really a model that we are trying to understand and unlock to see if we can be a great partner to the space in this area.
Mate, great work. I think you guys should be part of it. We need more support in the community to be part of the respite accommodation sector. I was at the Melbourne event in about May this year in 2022, and Alison from INHAD, an STA provider from Melbourne, she put all the numbers up on the board saying how STA, MTA is a big sector no one's looking into, and I'd been looking into it for the last 2 years. And then when she said that on the projector, I went, oh my God, the secret's out of the hat. Here we go. And then we decided to do the actual podcast with Rob Maxwell. And since then, a lot of people have been moving forward to communicate with us their interest in this area, because you don't need to actually have compliant SDA housing, but the concept is there. And there's just so much need for having more players come to the sector. So kudos to you guys at Barwon for doing this. My next question is, are there many fund managers like you in this space?
Look, there are a couple. They've probably been in the space a tad longer than we have. I'd probably say there's only other 3, maybe 4 fund managers at a similar level of pedigree, experience and capability as Barwon in the sector. But we actually all approach it in a slightly different way. So compared to others, we tend to take on a lot less development risk, preferring to acquire existing tenanted properties with hopefully with a bit of trading history. Or alternatively, we will actually partner with developers where we act as the takeout partner when the project is complete and tenanted. We found that this strategy has been, quite well supported by our investors, particularly with the really strong support in our second tranche of raising, and it allows new investors in the fund to get a stable, meaningful, consistent cash flow from the day they enter the fund, as opposed to others where they're going through that development process. It might take 24 or 36 months to get their projects up and running.
Gotcha. My next question is, what is it that Barwon likes about the SDA sector?
Yeah, well, the clear and obvious thing about this sector is the ability to invest in creating high-quality housing outcomes for people with disability, matching the housing with their particular needs, for a cohort that has been underserviced, really for a very long time. That is our clear objective, and that is why we are devoting so much time and effort in developing and investing in this space as opposed to other property sectors in Australia. Of course, second to that mission from an investor's perspective, we do think that the sector will continue to grow over the medium term. We kind of estimate that there's around about 10 to 12,000 places still needing to be created as the sector matures. And of course, the CPI-linked government-backed nature of the rents is a really positive aspect from a counterparty risk perspective.
I love your analysis of the numbers there, but I think you could triple those numbers, mate. So 12,000 times 3 is 36,000 plus the 17,000 already makes you 50,000 all up. Anyway, I won't argue about that here. We'll see in due course. Now, speaking of the sector, what are the challenges you've faced or are facing at the moment?
Yeah, sure. Look, I think there's a lot of really common challenges that many players are facing in the sector. Obviously, the consistency from the NDIA around SDA funding decisions, both from a process and timeline perspective is really important. The interlinked nature between SDA and SIL funding is becoming more and more important, to me. Sometimes those SDA decisions, funding decisions are being delayed or compromised because of the type of care package and funding package being approved for the participant on the care side. Clarity on where demand is and how participants actually want to live. I mean, the sector is really only, 3 years old, and we're all hurriedly and furiously innovating to figure out what great looks like for a participant. And so a huge challenge is making sure that the home or product that you're investing in or you're developing, is it not going to actually become obsolete over time as new competition comes into the market? We've got the dollar value of SDA funding is actually driving a lot of potentially unintended outcomes or delivery of product in the wrong place or not bringing the right product onto market. And so, that's a real big thing that we have to get our heads around in the sector as well, is how do we provide accommodation for the range of participants who need it, given the current dollar value of SDA funding. And of course, unlike the broader construction sector or property sector, the rising interest rates, rising build costs and rising land costs continue to put pressure on feasibilities for our developers that we're looking to buy new stock of.
Yep, that's great. I think our listeners, both who are investors and also developers and builders, should listen and take heed to what you just said there as a summary. My next question is, what do you want to see more of in the SDA space?
Yeah, I mean, it's a really complex sector, and so there's a lot of, we're still trying to find our feet. I think that's fair to say of everyone in the space. At the moment, we've got a lot of capital being drawn to the sector that, in our opinion, is being very poorly allocated. Whether that's into projects that don't align with participants' needs and objectives, things like poor local location or poor design, or, continued stock being delivered in areas that actually don't need it. They're already oversaturated with stock, and we'd prefer to see some of that stock go into some undersupplied areas. We actively track and analyze a lot of the NDIA data that comes out, as well as, data that we get from our SIL and SDA partners. And we've kind of developed a bit of a happiness score and a supply-demand balance score. So I'd just like to kind of, dwell on this point for a little bit. For a second. Sure. Whilst nationally, I think we've talked about on the podcast that around 15% of all SDA participants in an SDA seem a bit unhappy and they're seeking to move to a new SDA. There's actually pockets where those numbers are much, much higher. So Brisbane Inner City, in Queensland, that's 65% of people in an SDA and a new build SDA looking to move out, with 54% in Moreton Bay South, and 42% in the Gold Coast. So it seems like to me there's a lot of homes out there that just aren't hitting the mark with participants, and I think that comes down to being really engaged with your end user and your client and making sure that the design of the home is going to satisfy them.
Well, just want to jump in there. You mentioned the word Brisbane Inner City, Queensland, 65%. Are you saying 65% to want to move out of the existing SDA who are in the inner city of Brisbane?
That's right. That's
how did
the NDIA data is telling us.
So that would have come from a survey from the NDIS to their participants being surveyed there.
That's right.
That's a big number there, isn't it? Jesus.
It is a big number, and there's been some instances where again it comes down to my earlier comments around one of the biggest risks in this space is product obsolescence. So there's probably been a number of people who've moved into what I call the first generation of SDA apartments, that, were typically under 55 square meters, maybe designed a HPS and hoping all HPS will move in there. But as the sector has started to mature and more suppliers come online, we're now starting to see the standard size for a HPS SDA one resident unit, anywhere upwards of 85, 95 square meters. And that's a lot more compelling accommodation offering. So, that's something that we really attuned to, is making sure that the property we do buy is going to be attractive over the long term.
Future proofing is a very important phrase that investors should keep in the forefront of their mind.
Absolutely. And just touching on future proofing, I mean, there's a lot of supply coming online. We also track the demand supply balance across the different SA3 and SA4 regions that the NDIA figure comes out. And if you do a little bit of mathematics, you can easily see that places like Logan Bow Desert region in Queensland have 250 more places being developed, so that's either have been built or in the pipeline, than those who actually qualify for SDA at the moment. So, there's a bit of a backlog in places like Logan, like Ipswich, where there's quite a lot of supply relative to the amount of people with disability who actually need or will qualify for SDA. So it's not to say that those areas are absolute no-go zones, but you just want to be very careful that the product you're buying or the home you're buying is really in the top 5 or 10%. And that's what we think about when we think about buying blue chip, is something that's going to always be attractive to participants over the long term.
Great. You'll be pleased to know that we only have one robust house being built in Logan, and that's all we have there.
Oh, good.
We'll let you know when it's filled up, so we sell to you.
Yeah, great. Love to chat about it.
So moving on. So where were we? 250 places oversupply. What's any other comments about what you want to see more of in the space?
Yeah, I mean, I think, it's fair to say that a lot of the supply at the moment has been at that HPS level. It's something like 61% of all places being built are at HPS category, when it's estimated that less than 10% of SDA funded participants will be at that HPS funding level. And I think a lot of people have done that, some good reasons, particularly around if you do have a HPS design property or place, it can cater for people with IL and FA. So you do have that flexibility there. But as you can see, I think a lot of people and developers that we talk to are expecting that if they build HPS at a HPS level, they're going to get a SDA participant who'll be funded at that level. But the data shows you that's not going to be the case. So we'd actually really love to see more feasibilities and developers out there and players in the space actually designing for improved livability, fully accessible and robust funding levels, as they continue to be quite an underserviced part of the market, and they, as much as someone who's HPS, deserve a really high quality housing outcome.
Totally agree. We will try to avoid HPS where we can. There's not enough builders doing robust homes across Australia. Not enough, you know.
Absolutely.
And my honest opinion, professional opinion to our listeners are, just because you can build HPS doesn't mean you should. If it's FA is the market, then look, I know it's extra 30, 40 grand more to build it. I know, but you don't have to. The market demand is IL and robust. That's where it is. Yep. And at some point in the next 2 years or maybe 3, we're going to see a lot more complaints, feedback, forum chatter about, there's too many HPSs around Australia. It's all empty. Why can't I find a HPS tenant? Remember, if you're an investor coming to this market, you don't have to go and copy what everyone else is doing. You don't have to, because there's too many being built already. And that's already now, plus pipeline, plus the future potential. So consider what the market wants, everyone. If the market needs an IL or robust or an FA in your area, your area of interest, then go for that. Don't necessarily copy what everyone else is doing. No.
Yeah. I mean, just to contextualize it there for a moment, Min, I think we've got about 500,000 or just over that now enrolled in the NDIS scheme moreover. So what is that? That's kind of like 5% or less than 5%, 2% of Australia's population. Is that right? 10, yeah, about that. And then, when you think about that 500,000, only, circa 6% will actually qualify for SDA, right? And then only 10% of that 6% will only qualify for HPS. So, it's a very, very, very small subsect of the Australian population. There's a much larger component that will need improved livability or fully accessible and robust housing. And that's really where people should be, thinking about delivering product. Or if they are delivering HPS level product, just don't expect that you're going to get a HPS participant because, there's not a huge quantum of people out there.
Exactly. And outside of better quality housing for participants, what would you really love to see more of?
Yeah, I think it's fair to say we're really excited to see how the new government will engage with the sector and if there'll be any changes from the NDIA and engaging with the industry, so that we can actually all figure out together how to bring this quantum of accommodation online. It was touted that we needed to, at the beginning of the scheme, get about 5 to 7 billion of private capital investing in the space to be able to deliver all this accommodation. And I think we're still a fair while off that, and that's partly because of the nervousness of some investors around how to actually deliver really good product in the space. So I think, as a sector, in partnership with the government and the NDIA, getting a quicker set of approvals out there, getting everyone who, will qualify for SDA enrolled in the scheme, with an appropriate funding package so that we actually have some clearer line of sight into, how many people there are and exactly where they might be approaching the market for accommodation would be fantastic.
My next question is, what's your criteria for acquiring SDA products?
Yeah, so kind of going back to what we were speaking about earlier, blue chip is definitely, our front of mind when we're thinking about buying any SDA assets. SDA is genuinely and truly one of the most complex real estate asset classes in Australia, and I've worked across a few of those subsectors in my career. It's really complicated because it's heavily reliant on partnerships, right, with other organisations that attract and provide services to your residents in your accommodation. And these markets, as we've discussed, are very thin and often opaque in actually identifying where these participants are or where they want to live. So, key for us, as much as the financial returns, is actually who's involved in the project. We think your CILs and SDA partners are really critical to unlocking any SDA project. So you've got to have a great CIL partnership, to collaborate with, who may have participants already lined up seeking for a home. And you've got to have a great SDA provider who has experience in tenant sourcing, preferably in-house tenant sourcing capabilities, rather than just purely relying on external agencies, in the way that they can go and build great relationships with those tenants and then attract them into your properties and then actually provide really good housing solutions for them under their care. And then I'll kind of say it again, location for us is key. So that proximity to shopping centres, public open spaces, transport, not adjacency, but within close proximity to a hospital or healthcare operators for any of their healthcare needs as well. From a returns perspective, lots of people throw around cap rates and things like that. We tend to generally look at 20-year discounted cash flows on how we think something will perform. And, we're looking to provide our investors a target return of 8 to 10% over that kind of 20-year horizon, which predominantly is majority made up of income with a little bit of capital growth.
Mate, let's talk about the definition of blue chip, okay?
Yeah.
My definition of blue chip may be different to yours. Now, I want to bring it back to what this means in the layman's terms and then to help educate our investors more.
Yep.
My view of blue chip means using the eyeball test. You go to an area, you look at the streetscape, look at the house facades. That's one factor there. That's number one. Number 2, the quality of the shops, the shopping centres, the amenities around the street, around the suburb. Just by looking at it, you can tell whether there's plentiful of that being around. That's number 2. Number 3, the aesthetic of the house being designed and built. Right? Does it look cheap? Does it look nice? Does it have a nice facade? Does the quality look good? The lawn? That's number 3. Number 4, internally, is it spacious? Does it have storage space? There's wide hallways. There's plenty of space inside the bedrooms. Doesn't look too congested. There is automation throughout. There is highly adjustable systems, wardrobes, kitchen, tables, and whatnot. Nice backyard, garden, sensory gardens and whatnot. That, to me, using the eyeball test, the eyeball test, tells me that is blue chip to me. A high quality product in a high quality area with a high quality finished product itself. What is is that? Am I right to summarize it like that, or is there another version of blue chip in your mind?
No, I think you've pretty much nailed it. I think all of those things are completely appropriate for a blue chip definition. I couldn't add anything other than making sure you have great partners. Obviously, there's the buying process of any real estate transaction, and there's actually the managing and owning it. And we want to make sure that we've got really good partners in there to manage that asset, both CIL and SDA. But in terms of thinking about the type of house or dwelling that you might want to buy, I think everything you've listed there is terrific, and there's no real test better than going there yourself, walking through the property and going, I would really want to live here. And that's kind of the test we're trying to get to.
Yep, gotcha. Now, this next question is my most favorite question. I want to spend a bit of time on this topic because this is what's going to help produce more products in the marketplace, because you, as a fund manager representing the fund, you're all about the take-out buyer role. You don't develop, you actually buy built and tenanted assets. Yep. Obviously, in that whole chain process, there is the site due diligence, the acquisition, the construction, the tenancy sourcing, the delivery of the service. That's a bit of a 1 year process there in advance prior to you guys stepping in.
Yep.
The risk here are obviously your ideal product, and obviously, you don't like. Well, what's your favorite asset to purchase and hold on your books? What's your preferred?
Oh, look, we again are delivering a balanced portfolio for our investors. So we broadly think about 3. Buckets of types of assets. The first is standalone or detached dwellings, similar to the High Wycombe property we talked about earlier. The second is planned communities. So that's where we'll have smaller apartment buildings of, say, up to 6 to 8 units that are all SDA. We like those because it enables us to actually place real estate in areas of higher amenity, closer to proximity of shops and cafes and train stations by having a little bit more clustering. And then we also do integrated communities. So that's where we'll buy, usually up to 10 apartments plus a separate OOA within a larger residential development. So we like to have a balance across all those 3 buckets, because we fully acknowledge that participants are much like you or I'm in. They want to live in a range of different environments.
Gotcha. So I'll go back to my intent in a minute, but my question leading to this area is, what is the takeout buyer role that Barwon sees itself as in helping out with other investors or other stakeholders to come to market?
Yeah, sure. Well, kind of as I mentioned before, Barwon tends to not take on too much development risk. And in that way, our investors are seeking a risk-adjusted return on that basis. So we can be slightly more sharper in our pricing, because the development risks and the tenanting risks are passed over to our partners. So for any listeners, if they have an existing property, that's fully built and tenanted and are looking to do something else with their capital, or looking for an exit with a responsible manager to come in and carry on the legacy of what they've built. We can, of course, act as that takeout partner. So run an analysis, do the due diligence on the property, and acquire it. For developers who may have a plot of land, they may have a DA, they may not have a DA, and perhaps they're on their way to SDA design certificates being issued. We can look to structure a forward purchase agreement, so whereby, subject to the property being built, getting its occupation certificates, getting enrolled, and getting tenanted, we can sit there as at the back end as a purchaser, so that they can roll straight on to their next project, and that they have a certainty on a purchaser at the other end. For developers that are looking to maybe build a larger portfolio, so maybe 5 or 10 or maybe more properties over time, or maybe looking to do larger style plan communities, we can actually do a similar structure where we're a takeout partner, but we can also help provide some of the financing. So we actually act as a bit of a financier partner, and we'll actually help you acquire the land and then finance the construction through that project or that portfolio. So you might have some developers who really want to build a portfolio in this space, but might just be a bit capitally constrained. We can come in as their partner and help build out that portfolio with them. Gotcha.
So let's talk about, I want to use a case scenario example, and I won't hold you to this, so I'm not going to actually say anything. Sure. Let's say I have, and I do actually have this, I actually have a duplex site in Perth. Yep. For a HPS on either side of the duplex. It's for sale for $1.68 million, which works out to be about $840,000 for each side.
Yeah.
It is participant and provider led. So there's provider endorsement letters, comfort letters from civil provider, housing provider, and the builder also owns the block. This has been 3 years in the making here.
Yep.
I would like to see, again, this is my opinion, I would like to see one of our clients purchase the whole site, take it to completion, sorry.
Yep.
Knowing there's going to be, it's a 4-bed, 4-bath, 1 car on either side, it's HPS. The tenancy participant composition will be either a HPS plus 2 FAs or 2 HPSs and 1 FA. I would like to see this example go through to completion and then come back to you with a, hey, Barwin, we have a completed house, fully tenanted, with providers in place. Here it is. The rental amount is this amount. I call example of a 120 grand gross rent as example, round number.
Yep. Minus
cost of 30 grand. That's down to 90 net. $90,000 net at a cap rate of 8% makes it a $1.125 million asset in your calculations.
Yep.
All right. Then I'd say to you, hey, Barman, my client here has now finished this project after a year and a half. He wants out. As per your theoretical forward purchase agreement and the cap rate of 8%, in theory, would you like to buy this asset off this client for $1.125 million times 2? Right, knowing full well that he paid $840,000 for each side, being $1.68 million originally.
Yep.
You're quite happy as a asset manager to buy that asset because it's built and it's been filled up and de-risked for you. Is that correct?
That is correct. Correct. So under that structure, say it was already up and running, then we would be able to do a quick analysis on, how much is the property earning? How much do we think it's going to earn over the long term? What is the underlying land value? We've got to factor that in as well. What does that all come back to a number, and we can come up with a price. Or alternatively, you might have someone who says, hey, I'm going to buy this project, but I know I'm not going to want to hold it forever. And we can similarly say, okay, well, subject to you hitting these KPIs, which will be achieving a certain tenant mix, achieving a minimum revenue, et cetera, this will be the purchase price. And then when those conditions are satisfied, we would then settle on that property.
Wonderful. Well, at least this gives our listeners an idea as to what their exit strategy could be.
That's right. Yeah, we're really here to be, a real estate partner to our SDAs and our tenant participants, but also a capital partner for the developers in this sector as well. So whether they're looking to exit a project or they're looking to help get a project up and running, we can have a discussion around, either situation.
Gotcha. My last question is, if any listeners out there are interested in investing in SDA, but perhaps would prefer to do it through a balanced portfolio approach like the Barwin is creating, is that something that can do to approach Barwin as a fund manager?
Yeah, absolutely. I mean, we have raised 64 million now across our 2 tranches. We've just closed on the most recent round, but we with the projects we've got in the hopper and pipeline at the moment, we'll be back out to the market and over the next 6 to 12 months to see if investors out there, new and existing, would like to increase their investments in the space through us. One thing for us is they will need to be a wholesale or sophisticated investor. But if they are interested, they can register their interest through our website. So if you go to barwin.net.au and navigate their way to the Barwin Disability Accommodation Fund portion of the website, there should be an EOI that they can put in there, and our team will be in touch. I mean, part of the benefit of investing through a balanced portfolio like Barwin is creating, across Australia, is you do get access to that income generating portfolio right now. So you don't have to go through the kind of heartache of buying the site, waiting, 12 to 18 months to get approvals and get it built, and then, maybe another 6 to 12 months to get it tenanted. And, you do have seasoned professionals like myself, fretting 24/7 around how to take care of our investors' return and maximize their returns for them over the long term. So if anyone is interested in investing in SDA through a fund, please, of course, reach out.
Joz, can you give us a definition of what the word wholesale investor means?
Sure. So wholesale or sophisticated investor is basically someone, I think, with over 250,000 a year in income and or over 2.5 million in assets is my memory of the definition. So you will just need to get your accountant to sign off that you are a sophisticated or wholesale investor before we can put you into the fund.
So if they do qualify with those criteria, what is the minimum investment into the fund?
Oh, the minimum investment is 100,000.
Okay, gotcha. And the MER fees of the fund?
We've got a expense rate, what you've referred to as a management expense ratio. We call it a management fee, and it's 0.75% of funds under management.
Sorry, there was a little bit of a static background noise there. What was the fee again?
0.75% of funds under management. So it's more because we're an institutional firm. It's at a lower level because institutions generally require a lower fee. Mm-hmm. So that 0.75% is our management fee of funds deployed. Our structure of how we source funds or investors can place funds is we have committed capital. There's no fee on committed capital, only when it's invested.
Gotcha. So one last thing before we hang up the call here, Joz, is across my travels in the last few weeks, 2 months now, I've come across various different parties, stakeholders, which I think could really work well with Barwin. I was in Canberra on the weekend just 2 days ago, and I saw the Respite STA kind of service really well run in Canberra by 1 or 2 different groups. I reckon if you guys are thinking about that kind of market entry, I want to do an introduction to you guys to someone there who may be interested in the kind of facility that you want to put in place in those metro or capital cities around the place. We just had before this podcast, our whole team just had a Zoom call with a very large land developer and builder in Sydney. And they're wanting some guidance as to how, if and when they should enter this SDA space. And I think if there is a large takeout buyer like yourselves in the back end who are sort of semi-dictating what they need as assets in certain areas and regions around New South Wales regional and metro, if we can really collaborate together with our potential buyers in advance who will actually go out and purchase the land and do the builds with the design customization of this builder as per your required needs in the back end, I think we can really provide a solution here because you need that product to be built and tenanted. And I think if we can I've come across a recent company that will do the head leases at the very start, 1, 2, 3 years, 5 years. They'll give reassurances to our mum and dad investors to go in to create the product that you would like to see more of in these certain areas as per the demand. And that could really work in collaboration together, being the builder, the providers, the investor, the participants, and Barwon, the takeout buyer, could really work out well. And I really want to see this opportunity come into alignment in the coming month or 2 months with more of a face-to-face meeting with yourself and these people I'm talking to really produce the right products in the market. Yeah,
sounds fantastic. And for any STA operators out there, it's still, or MTA, it's still something we're still getting our head around. So we would love to have discussions. We don't profess to be the experts in operating these properties, but we are pretty good at the real estate side. And so we're keen to partner with operators who really understand that space of how we can deliver the real estate solution that matches their operations.
Jos, I always conclude every podcast interview with a question, and that question is, and do you have any final words of advice to our listeners on those who are thinking about venturing into the STA space?
Oh, good question. I think anyone looking to get into the SDA space, I firstly and foremostly encourage it. It's a fantastic opportunity to deliver, high quality housing solutions for a very underserviced part of our population. But I do just caution that don't run into it too quickly. Make sure that you want to get into it for the right reasons, and that's delivering a really high quality outcome for those participants. And make sure that you do your research and your due diligence before getting too far involved. Just be very cautious. Like any sector, there's a mixture of different quality counterparties out there. But whilst it's complex and whilst it's challenging, when you get it right, it's incredibly worthwhile, and it really does make a difference to people's lives.
Fantastic. Jos, thank you so much for your time. We're going to have a great long-term relationship, seeing that we're going to see each other more often at all the events and expos and the speaking circuit. But thank you so much for your time, and appreciate all the things you guys are doing at Barwon there.
Thank you, Min, and appreciate everything you're doing with the podcast for the sector.
Thanks, mate. Bye-bye. Cheers.
Bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.